Welcome to Iron Financial. This is the place where we forge stronger portfolios by taking companies and stress testing them right down to their foundations. We cut through all the market noise to find the actual steel underneath. Today, we are putting Main Street Capital under the microscope. The ticker is MAIN. Now, this company is a real darling of income investors. But here's the problem. The very ground beneath its entire sector is shaking. It feels like an earthquake. So the question we're asking today is really simple. Is this company a financial fortress built to last? Or is it just a house of cards, just waiting for the wind to change direction? Let's find out.
And that really brings us to the core of what we need to figure out today. The entire business development company sector, you'll hear us call it the BDC sector, is completely under siege. There's no other way to put it. And for the income investors out there, the people who rely on these high-yield vehicles for cash flow, the stakes just could not be higher. They're looking for safety, they're looking for income in a market that is offering very, very little of either right now. So the big question is, can Main Street Capital, which is one of the biggest and most respected names in the space, can it truly defy the gravitational pull that's dragging all of its peers down into the mud? Or is it only a matter of time before even this giant succumbs to that immense pressure?
All right. Before we get all swept up in the bull case, let's just lay out our game plan. I want you to think of this as a structural engineering test. First, we're going to survey the BDC battleground, just so we can understand the war zone that Main Street is operating in. Then, we'll inspect Main Street's supposed financial fortress and take a hard look at this dividend's steel backbone. But hey, no structure is perfect, right? So then we'll go searching for cracks in the armor. We're going to ask the tough questions, like why Wall Street seems to be giving it the cold shoulder. And then finally, we'll deliver our verdict. Is this thing built of solid iron, or is it just a bunch of hype? Let's get to it.
Okay, let's dive right in. Before we can even begin to properly analyze Main Street's structure, we absolutely have to understand the battlefield it's fighting on. And make no mistake, the BDC sector is not for the faint of heart right now. It is a sector under siege. It's facing this constant barrage of economic headwinds that are really testing the resolve of every single company within it. You have to remember, no company, I don't care how well managed it is, operates in a vacuum. And this context, this environment, is absolutely critical to understanding the risks and, yes, the potential rewards here.
And this right here, this is what that siege looks like. The pressures are coming from literally all sides. First up, you've got these rising non-accruals. Look, that's just a fancy Wall Street term for a simple problem. The companies that BDCs lent money to are suddenly not able to pay their bills. The loans are going bad. Simple as that. Now, that, of course, leads directly to the next problem, bankruptcies. The small and mid-sized businesses these firms finance are really struggling in this economy. And on top of all that, when interest rates eventually do come down, it's going to squeeze the earnings of these BDCs. The market sees all this coming, it's not stupid, and as a result, valuations across the entire sector are plummeting. Many of these companies are now trading for less than they're supposedly worth on paper. So this isn't some light rain we're talking about. This is the hurricane Main Street is sailing directly into.
So, against that bleak and frankly terrifying backdrop, Main Street Capital has built what the bulls claim is a financial fortress. They argue it's not just surviving this storm, but it's actually thriving in it. But here at Iron Financial, we don't take anyone's word for it. We look at the blueprints, we test the materials ourselves. So it's time to inspect the foundation of this company, by the numbers, and see what it's really truly made of. Let's start with the headline number that just blew everyone away. $1.11. That was the Q4 earnings per share. Now, Wall Street analysts, the so-called experts, they were expecting $1 and a penny. Main Street didn't just meet expectations, it completely smashed them. That's a nearly 10% beat. You have to understand, in a sector where so many competitors are struggling just to stay afloat, reporting losses or these tiny little gains, a beat of this magnitude is an incredibly powerful statement. This isn't just a small tremor of good news. This is the first heavy, load-bearing pillar in the foundation of the entire bull case.
Next, let's look at the top line, revenue, a 3.6% year-over-year increase. Now, I know what some of you might be thinking. In a high-flying tech sector, that number might not turn any heads. But you have to remember the battleground we just described. In this environment, any growth is good growth. Solid, foundational, year-over-year growth of 3.6% demonstrates a level of stability and resilience that is just sorely lacking among its peers. This isn't about speculative, explosive growth. This is about building a solid, reliable, revenue-generating base that can withstand economic tremors and continue to fuel that all-important dividend.
And now for what I consider the steel reinforcement of the whole structure, return on equity.
For the full year of 2025, Main Street delivered a staggering 17.1% ROE. This is an absolutely crucial metric. In simple terms, it tells you how efficiently a company is using its shareholders' money to generate actual profit. So for every $100 of shareholder equity they have, they generated over $17 in net income. To put that into perspective, a 17% return is fantastic in any environment, but in this sector, it's simply best in class. This shows that management isn't just treading water. They're actively and very successfully deploying capital to generate superior returns. This is the proof of a highly profitable and efficient operating machine.
Okay, let's drill down even deeper into the engine room here. This table shows the guts of their Q4 performance. Look at that top line, total investment income. That's basically all the money coming in from their loans and investments, and it's up a very healthy 4%. But here's where it gets really interesting for us. Look at the next two lines. Net investment income, or NII, is up 6%. This is their core profit, after all their financing and operating costs are paid. And even more importantly for income investors, distributable net investment income, DNII, is up a solid 7%. Now this is the metric that matters most for dividends. It's the actual cash earnings available to be paid out to you, the shareholder. Seeing this number grow so robustly is a powerful, powerful sign that the dividend isn't just safe, it's got plenty of fuel to grow. This is the core engine, and right now it is humming.
And the bull case just gets stronger when you look at the other structural components. These are the thick fortress walls we're talking about. First, net asset value, or NAV, has grown for the 13th consecutive quarter. Think of NAV as the company's book value per share. It's what the company would be worth if it sold off all its assets tomorrow. A consistently growing NAV means the underlying value of the business is increasing quarter after quarter. That's a powerful trend you can't ignore. Second, look at the portfolio quality. The fair value of their investments is 117% of what they originally paid for them. This means they are brilliant investors who have picked winners, and their portfolio has significant unrealized gains just built right in. Third, they're not just sitting on paper gains, they're actually cashing them in. The recent sale of a company called KBK Industries netted a $17.3 million realized gain. This proves their ability to successfully exit investments for major profits. And finally, operating efficiency. Their expense-to-assets ratio is a lean 1.3%, which is industry-leading. They run a tight ship, which means more profit drops straight to the bottom line for shareholders.
Okay, you know what? I'll concede the point. The operational numbers, they look solid. From a pure accounting perspective, the structure seems really well built. But let's be honest with ourselves. For the people who are actually investing in BDCs, like Main Street, there's really only one number that matters more than all the others combined, and that's the dividend. Is it durable? Can you actually count on it when times get tough? An income investor doesn't care about a beautiful fortress if they can't get any gold out of it. So let's stop admiring the walls for a second and start inspecting the vault. We need to see if this dividend really has a steel backbone or if it's all just talk.
And this right here, this is that steel backbone, right here in black and white. The numbers don't lie. This is not a stagnant dividend, not by a long shot. Compared to the exact same time last year, the regular monthly dividends paid out in the last quarter are up over 4%. And if you look at the last 12 months, the growth is also over 4%. This is the undeniable proof of a company not just maintaining, but actively increasing its commitment to its shareholders. In a market where so many companies are cutting their dividends or just freezing them entirely, Main Street is consistently raising theirs. This isn't a hope or a projection, it's a proven track record of rewarding the people who actually own the stock. For income investors, this is the absolute core of the bull thesis.
But wait, it actually gets even better. On top of that consistently growing monthly dividend, Main Street regularly pays out supplemental, or you can call them special dividends. Just look at this schedule from 2025. In addition to their regular monthly checks, shareholders received an extra 30 cents per share every single quarter. That's an extra $1.20 for the year. A company does not do this unless it is absolutely overflowing with distributable income. This isn't a company that's just getting by. This is a company firing on all cylinders, and they're sharing the spoils of their successful investments directly with its owners. This two-tiered dividend approach, a stable growing monthly payment, plus these significant quarterly bonuses, is what truly, truly separates Main Street from the rest of the pack. All right, hold on a second. You're painting a beautiful picture here. A mighty fortress on a hill, just showering its people with gold. It's a great story, I'll give you that. But every structure, no matter how strong it looks from a distance, has potential weak points. You know, a crack in the foundation, a poorly defended gate. We've heard the bull case loud and clear. Now it's my job to play the role of the siege engineer. It's time to stop admiring the architecture and start pressure testing this thing. Let's go looking for cracks. And here's the very first thing that catches my eye. The rate of growth. On the left, you see the 5-year compounded annual growth rate for revenue, 20.5%. That is a solid steel beam, no doubt about it. That's the history that built this company's entire reputation. But now look at the right. The annualized growth over just the last 2 years is a mere 6.4%. Now, the bulls will say, oh, it's just the law of large numbers. A company can't grow at 20% forever. But a skeptic has to ask, is the high-growth engine sputtering? Are the company's best days of expansion now behind it? Or is competition in the private credit space getting so fierce that even the best operator is struggling to find good deals? Is that rust I see on that once gleaming steel beam? A slowdown this dramatic warrants a much, much closer look.
And when we do look closer, we find more potential issues. First, there are declining yields on their core investments. The yield on their key portfolios is heading down, which puts direct pressure on future income. That's just math. Second, access to capital. BDCs constantly need to raise new money to make new loans. If capital markets tighten up, if money gets harder to come by, their growth engine could completely seize up. Third, and this is the big one that nobody likes to talk about, is principal loss risk. You're not lending to Apple or Microsoft here. You are lending to smaller, much riskier companies. There is always the inherent risk that some of these loans go completely bad and you lose your entire investment. And finally, credit market volatility. Look, Main Street's internal performance has been great, but it can't fully insulate itself from what's happening in the broader economy. If credit markets freeze up or panic, Main Street will feel the pain. Now, the bulls will say they manage that risk better than anyone. Better, maybe, but they can't eliminate it. These are not trivial concerns. You can't just overlook this stuff.
So that brings me to a very simple but a very, very important question. If this company truly is the impenetrable structure that the bulls claim it is, with a dividend made of solid steel, then why are the so-called experts on Wall Street giving it such a lukewarm reception? Why aren't the professional analysts, the people who do this for a living, why aren't they banging the table telling everyone to buy this stock? The analyst consensus is a critical data point, and right now it's telling a very different story from the one the bulls want you to hear.
Let's just look at the evidence. This donut chart breaks down the consensus rating from the 6 Wall Street analysts who cover the stock. A full 2/3 of them rate the stock a hold. And look at that, 0% have a strong buy rating. I mean, think about that for a second. 2 out of every 3 analysts are effectively just on the sidelines. They're telling their big money clients, don't sell it, but they are certainly not advising them to rush in and buy it either. To me, this suggests they see the very same cracks that I've been pointing out. They see the slowing growth, they see the declining yields, and they see the sector-wide risks, and it's making them cautious. This is a major red flag.
And here's the real kicker. Even the analysts who are neutral to positive on the stock don't see a whole lot of upside from here. The consensus price target among them is $61.17. From a current price, that represents a potential upside of just 4.03%. So let me ask you this. Are you really willing to take on all the risks of the BDC sector, the bankruptcies, the credit volatility, the principal loss risk, all of that for a potential reward of just 4% plus the dividend? For many, many investors, that risk/reward calculation simply doesn't add up. The professionals on Wall Street seem to be signaling that the stock is, at best, fully valued, leaving very little margin of safety for new investors coming in today.
All right, you've made some valid points. The analyst caution and the growth slowdown are absolutely data points that cannot be ignored. Every single investment has 2 sides, and we've laid them both out on the table. We've inspected the foundation, we've tested the walls, and you've certainly checked for cracks. So now it's time to step back, weigh all the evidence, and deliver the iron financial verdict. Is Main Street Capital an opportunity to buy best-in-class quality at a fair price? Or is it a trap, a seemingly strong structure that's just built in a neighborhood that's about to be flattened? First, let's consider the perspective from the command center itself. This is the CEO, Dwayne Hyzak, speaking right after their record-setting quarter. He's talking about the sustainable strength of their platform and their confidence in delivering superior results. You can just feel the confidence from management. They truly believe the structure they've built, with its differentiated investment strategies and its super cost-efficient operations, is not just some temporary shelter. They believe it's a platform that's designed to last and to continue rewarding shareholders through any economic cycle. And frankly, they've earned a lot of credibility over the years. Their execution has been pretty close to flawless.
So this is where we land. The evidence from both sides leads to one very clear synthesis. The lead analyst in me sees the undeniable facts. 13 straight quarters of NAV growth, a 17% return on equity, a lean operating structure, and a growing dividend that is backed by rock-solid distributable income. Main Street Capital is, without a single question, a best-in-class operator. It might be the best in the business. But the market skeptic in me cannot ignore the flashing warning signs all around it. A BDC sector that's under immense pressure, slowing top-line growth, and a Wall Street consensus that is decidedly unenthusiastic. So the verdict is this: Main Street has built the strongest fortress in a very, very high-risk neighborhood. One statement is an assessment of quality, the other is an assessment of risk. And right now, both are true.
And that ultimately brings the final decision back to you and your own portfolio strategy. Main Street has proven its strength. The steel is real. The foundation is solid. But the question you have to ask yourself in this market is whether buying a defensive, best-in-class income producer is the right move for your goals. Is playing defense the best offense for your portfolio right now? Or are the risks of the neighborhood simply too high, regardless of how strong the fortress is? That's a strategic decision every investor has to make for themselves. Thanks for joining us at Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.